Okay, big tech is spending an astronomical $725 billion on artificial intelligence over the next few years. But here's the secret they really aren't advertising. They're not spending that money buying more software apps. No, they are buying electricity. They're buying heavy machinery. They're buying copper. In any gold rush, the absolute surest way to build wealth isn't to go panning for gold in the river. It's to be the person selling the picks, the shovels, and the pickaxes. And right now, the biggest companies on Earth are placing the largest pick and shovel orders in human history. Welcome to The Explainer. Today, we're shifting our focus entirely away from that relentless software hype we hear about every day. We are moving beyond the Magnificent Seven to look at the heavy industrial supercycle that's actually powering the AI boom. We're going to uncover who is truly cashing big tech's massive checks by diving into what's known as the AI plumbing play. And guys, it is incredibly important to pay attention to this shift, because if your portfolio is completely tied up in software and digital platforms right now, well, you might be completely missing the biggest physical infrastructure build-out of our generation. So here's our roadmap for today. We'll start with the $725 billion pivot, look at the AI power gap, dive into thermodynamics and copper, check out grid bottlenecks, talk about data center landlords, and finally wrap up with the valuation arbitrage. Let's jump right into Section 1, the $725 billion infrastructure pivot and the hyperscaler CapEx surge. Look, we are currently witnessing a historic realignment in global capital markets. The primary constraints on the expansion of AI have officially migrated from the digital realm of bits to the physical realm of atoms. The hyperscalers, Amazon, Microsoft, Alphabet, and Meta, are guiding their capital expenditure to jump from $410 billion in 2025 to an absolutely staggering $725 billion in 2026 alone. That's a 76.8% total growth rate in literally just 1 year. Now, to put that $725 billion number into perspective, if you adjust for inflation, the entire Apollo space program, the one that put humanity on the moon, cost around $257 billion. So big tech is spending nearly 3 times the cost of the moon landing just to build out AI infrastructure over the next couple of years. And this capital isn't going into sleek chatbot interfaces or, code optimization. It's being aggressively funneled into the physical foundation of the AI economy, power grids, cooling systems, and massive industrial hardware. Moving to Section 2, the AI power gap and exactly why bits need more atoms. To truly wrap our heads around why this physical infrastructure build-out is happening so aggressively, we really need a quick technical breakdown of a fundamental physics constraint, like why do digital bits suddenly need so many physical atoms? Well, let's do a fast 30-second breakdown of the sheer scale of the energy disparity here. A standard enterprise server, the kind that has quietly run the internet, your email, your web browsing for the last decade, typically operates comfortably within a power envelope of, say, 300 to 500 watts. These standard servers process tasks sequentially, one right after another, which is a relatively low-power operation. But AI is fundamentally different. A single AI-optimized chip, like the NVIDIA H100 GPU, demands over 700 watts all by itself. Why? Because it relies on massive parallel processing, running thousands of complex calculations simultaneously. And when you pack 8 of these into a single server node, that one node suddenly pulls 10 to 11 kilowatts under load. AI chips literally require multiples of the electricity used by standard computing. And as we scale this up to the rack level, well, the problem compounds exponentially. Traditional data center racks were historically designed to handle about 10 to 15 kilowatts of power. Modern AI racks, they're pushing anywhere from 40 to 140 kilowatts. That is a massive 4 to 10 times power multiplier, but the roadmap definitely doesn't stop there. The hardware requirements for next-generation 2030 supercomputing clusters demand an astonishing 1 megawatt of power per rack. That's a 66 times power multiplier. Just imagine taking the engine out of your standard 4-door family sedan and trying to replace it with a massive commercial jet engine inside the exact same physical footprint. That is the level of power density we're talking about bringing into these facilities. This exponential gap is forcing a total, ground-up reimagining of how we actually deliver power to computing. Which brings us to Section 3, thermodynamics and the copper deficit. Basically, the physics of intelligence. So when you pull a megawatt of power into a confined physical space, you generate an apocalyptic amount of heat. Traditional air cooling, which is essentially just blowing really cold air from massive air conditioners down a server aisle, it hits its physical limits at about 20 kilowatts per rack. It simply cannot cool the future of AI. So thermal management is evolving drastically.
We're transitioning from intermediate rear-door heat exchangers straight into direct-to-chip liquid cooling, which pipes cold liquid directly over the processors and is quickly becoming the mainstream AI standard today. And eventually, we're going to move toward full immersion cooling for frontier, high-density racks. Immersion cooling literally means taking millions of dollars of cutting-edge, highly sensitive computing hardware and completely dunking it into a high-tech bath of specialized, non-conductive fluid. Companies providing these advanced liquid cooling solutions, like Vertiv and Trane, are seeing an absolute explosion in demand, simply because AI physically cannot function without them. It would literally melt.
But solving the heat problem introduces an entirely new materials problem. 44 metric tons, that is the amount of raw copper required to build just 1 single megawatt of AI-optimized data center capacity. Think about that. That's roughly the weight of a fully loaded commercial airliner, just in copper wire and busbars. And it's nearly double the copper intensity of a traditional computing facility. When you scale that up, a single large 225 megawatt data center can require nearly 10,000 metric tons of copper, just for its internal power distribution, its cooling loops, and connectivity wiring. That's basically the equivalent of building the Eiffel Tower completely out of solid copper wire.
And the macroeconomic consequences of that localized demand are just staggering. By 2040, the global market is facing a projected, alarming 10 million metric ton structural deficit in copper. AI training is essentially devouring this essential metal at the exact same time that global electrification is peaking. I mean, consider the fact that every single electric vehicle manufacturer, solar farm, and wind turbine project is also fighting for that exact same limited copper supply. It is a massive clash of physical industries, and this dynamic makes copper mining, refining, and fabrication one of the absolute most critical choke points of the digital age. Now for Section 4, the electrical grid bottleneck, or what we call the 5-year wait. The most severe physical roadblocks to AI expansion actually aren't happening in the boardrooms of Silicon Valley at all. They're forming outside the facilities, out on the local utility grids. Analysts call this constraint the maturity mismatch. See, the AI hardware innovation cycle moves at breakneck speed, with new, way more powerful chips dropping every 12 to 18 months. Software engineers are iterating in days, but the physical world is stubbornly, frustratingly slow. If a hyperscaler wants to pull massive power from the grid, they need a high-voltage power transformer. Well, the wait time for one of those custom-engineered transformers has ballooned to up to 5 years. That's largely due to intense supply chain backlogs and a real lack of skilled labor. And what if we want to dig a new copper mine to harvest the raw materials to feed those transformers? Environmental studies, permitting, financing, the physical drilling. All of that means a new mine takes an average of 17 years from the initial discovery to the very first production of refined copper. You simply cannot write a software patch to bypass a 5-year delay in heavy industrial switchgear. Section 5. AI Data Center Landlords, the Real Estate Proxy. Because access to power on the grid is now the ultimate bottleneck, the entities that already hold the power hold all the cards. Institutional investors are realizing a brilliant bypass strategy here. You don't actually need to bet on which specific AI software application wins the market if you own the physical building that the software is forced to run in. Enter the data center real estate investment trusts, or REITs. We're talking about companies like Digital Realty, which operates over 300 massive facilities, and Equinix, boasting record annualized gross bookings of $1.6 billion. We also see specialized players like Hannon Armstrong focusing heavily on sustainable grid infrastructure. These landlords command incredible pricing power right now because they control the one asset hyperscalers absolutely desperately need: permitted power. Think about it. Microsoft and Amazon has billions of dollars in cash, sure, but they can't buy time. They can't spend 4 years fighting local zoning boards and utility commissions for new power grid access. So instead, they have to sign massive long-term leases with the REITs who already have the keys to the grid. The fundamental financial strength of the hardware providers inside those buildings, those so-called plumbing stocks, is equally fascinating. Let's look at the concept of a CapEx-led growth cycle. Vertiv is projecting nearly 30% organic revenue growth, and it's backed by an astonishing record backlog of $15 billion. Trane Technologies is sitting on a $10.7 billion backlog. Now, contrast this with big tech. When a tech giant increases CapEx to buy AI chips, they're spending money speculatively on a hope, basically banking on a future software return on investment. But when these plumbing stocks increase their CapEx, they're building new factories because they already have tens of billions of dollars in guaranteed, legally binding booked orders. It is a completely different risk profile, backed by real booked revenue. Section 6. Smart Money Valuation Arbitrage. This is the brutal truth. This brings us to the brutal truth of the current market landscape, and really the core financial takeaway of this entire deep dive. We are seeing a stark, almost unbelievable divergence in how capital is being deployed right now. On one side, you have retail investors, often aggressively chasing highly saturated AI software and digital hype stocks at massive multiples of 40 to 50 times forward earnings. They're doing this despite a rapidly growing risk that the software just won't be able to monetize fast enough. But on the other side, the institutional smart money is quietly, methodically rotating into the physical infrastructure. They're buying regulated utilities at roughly 19 times earnings and heavy copper mining companies at under 12 times earnings. They're securing critical, real-world physical assets at massive discounts, while the broader public retail market blindly chases the digital hype. So I challenge you to look at your own brokerage account right now. Are you playing the 40x multiple retail game or the 12x picks and shovels game? This massive institutional rotation is perfectly captured by the thesis of legendary investors like Stanley Druckenmiller. He's arguably one of the most successful macro investors in financial history. Druckenmiller has actively rotated out of sky-high compute stocks like NVIDIA and pivoted heavily into power and infrastructure. His operating thesis summarizes this entire market shift beautifully. He said, "The bottleneck for AI has shifted from compute to power, and the companies solving the power problem are where the next leg of alpha will be generated." Look, when the smartest macro money in the world abandons the silicon chips to buy the power lines, it is absolutely a signal worth paying attention to. As we wrap up this explainer, I really want to leave you with a provocative thought. The next phase of the artificial intelligence boom will not be defined by who has the smartest or fastest chatbot. It'll be defined entirely by the harsh, unyielding physical constraints of the real world. So ask yourself, when you look beyond the sleek software interface on your phone, who actually owns the power, the raw metal, and the physical grid infrastructure necessary to run the future? Thank you so much for joining me for this deep dive today, and keep your eyes firmly fixed on the physical foundations of our digital world.